Hey everyone, it's Kirk here again from Option Alpha. So I got up this past weekend, probably really too early, and was thinking about the Fed and interest rates and basically what happens when the Fed starts a rate cutting cycle. So I did some research on this and published a new article that goes over not only what happens during different Fed cutting cycles, but also what I'm going to be doing in my portfolio. So in this video, I want to go over that research with you guys and then also show you how I'm making adjustments to some of the bots that I'm running inside of my own account. So first things first, you'll see the new research. It's up on the blog here, so you can go over and take a look at it. Of course, share it with your friends. A lot of people, I think this is going to be very counterintuitive, where people assume that when the Fed cuts rates, that's very stimulative, but it's actually not the case. If you actually go back and we look at the different time periods, and we go back to basically the last 3 cycles of rate cutting, which start basically in like the early 2000s, essentially, what we see is that every time that the Fed starts a rate cutting cycle, it is usually a precursor to a market top or to a lot of volatility. And we've seen that in the last 3 major cycles. And the reason I chose those last 3 cycles, not only because they're just the most recent ones, but also it just seems like since 2000, the Fed has had a bigger and bigger role in the markets, where now everyone is kind of keying off of what the Fed does. It's a big event every time that they speak or every time that they sneeze or whatever the case is. So that's why I think it's even more important now. It's just becoming a bigger and bigger part of the market. So if you go back and you look at the average drop of the S&P for each of the rate cutting cycles, so the first one that started basically in December 2000 around the dot-com bubble, and then you got August 2007, so it's a little bit of a precursor to the global financial crisis, but that's essentially when they started cutting rates. And then in August of 19, that's when they cut rates as well, right ahead of the pandemic that was coming. Now, we didn't know the pandemic was going to come, but they also cut rates during that time period heading into that, so we saw that as well. But you can see that pretty much all of these different cycles had a cycle low where the S&P was down 25 to 40%. That's pretty consistent across the board, that at some point during the next 1.5 to 2 years, we would have probably a big drop. Now, this is actually very interesting for options traders because, one, it means that there's going to be a lot more volatility, which is great for option sellers and premium sellers. It means that all of the low volatility kind of grinding higher that we've seen is probably going to come to an end, which means that options traders in this environment can really flourish because we have a lot more strategies that can take advantage of market volatility like this. We can profit from the market moving down. We can profit from low volatility going to high. We can profit from high volatility coming back down. So there's truly a lot of opportunity here, which is why you should be excited about it. And then also just knowing that this is going to happen means that we're kind of going to go through a regime or cycle change here that's probably going to start happening as we get towards the end of this year. So that's really important for how you kind of position your portfolio and your bots. Now, if we actually take a look at each of these individual periods, and you can just bring up a chart of them. I put them on the research blog article so you can take a look at them there. But this is basically the period heading into the dot-com bust for the S&P. And you can see right here in about December, that's when the Fed actually started cutting rates, was right there in December. It started to go from a high rate period, which was, I forget where it was at that time, but it started to cut rates at that first December meeting. And then what you saw after that, so if you just kind of take a line right there, is you saw a huge decline in the markets. Now, I don't know if this was the case where, the Fed was kind of trying to get ahead of things, as always. That's always the argument for this, is like, well, the Fed cuts rates because they're trying to get ahead of things. They're trying to, stop unemployment from continuing to rise. But it just never seems to work, honestly. Like, all the stuff for the last 3 years just really doesn't seem to work. And so what we saw is we saw a pretty big decline over the next year and a half in the markets. So that was the dot-com bust. Then you get to the global financial crisis. The Fed actually started cutting rates back here in 2007. And so in 2007, which was actually well before things got really, really hairy in 2008, towards the later part of 2008 and early 2009, they actually started cutting rates and started cutting rates pretty aggressive. And at first, and this was an interesting one, I just thought of it, like seeing this and going through this, is at first the markets were very responsive to this. You saw the S&P climb back up out of a low point. This is a weekly close candle here. So you can see the market kind of climb back up. And we had a lot of time, basically from the first time they started cutting rates, for about 6 months where the market actually recovered and went back up. And so we had this period of, kind of like false optimism where the market rallied back up And then after that, it just never recovered and had, what many people have traded through. I remember trading through it myself. It was pretty crazy, pretty wild. We had some pretty big down drops, and the market basically got cut in half. So the Fed continued to drop rates that entire time. So it really didn't help. It seemed like they were kind of trying to catch a falling knife. All right, so now fast forward. Now we have the COVID one, which many people might have traded through as well. If you're a new trader, you maybe didn't trade through this. It was equally as wild, but it was very short time period. And so the Fed actually started cutting rates well before the actual pandemic drop. Now they couldn't have expected that we would have a global pandemic. Obviously, nobody could have expected that type of black swan, but nevertheless, it happened, and it happened in a rate cutting cycle where we saw the market decline. What is interesting about this one, and I notated in the research as well, is that it was not only equally just the fastest decline we've ever had, but also the fastest recovery. And what was interesting to me is just the response that we saw from government, not only with rates just dropping basically to zero, but then all the stimulus that was pumped into it. I might even expect that we would do something like that if we get another major shock and we drop really fast. It would not be surprising, whoever gets elected, for there to be massive government stimulus coming back in. So just be prepared for that. You could have quite the whipsaw event start to happen. But now if you even look at the chart of where we're at here, you can see that we're going to get into another rate cutting cycle. The markets have obviously had a huge run and a good run. But now it's probably a time period where you should now start to move things and start to tilt things a little bit different, maybe even just cautiously bearish on some of your trades. So I outlined inside the article a couple things that I'll be doing inside of my portfolio. It's down here at the bottom, basically with the things that I'll be doing inside my portfolio. Again, three major things. One is I'll be tilting bot exposure slightly more bearish. Now this can come in many forms. If you're trading and making auto trading and using bot exposure, or you're letting your bots choose direction or trend or things like that, you might want to tilt them a little bit more bearish. For example, I will be adjusting my beta exposure in some of my pure EV bots that I still run and giving it a little bit more room to grab bearish exposure. So I'm actually going to do that with you guys here so you can see that. So this is just one of the EV bots I run. This one's kind of neutral. Some are good, some are bad. They don't all have enough potential trades right now to kind of publish all these right now. They've only made, in this case, 28 trades. So still not statistically significant enough in either direction. So it's kind of a neutral one to look at. But you look here at how I run this bot, and inside of my pure EV scanner, what I'm going through is I'm going through a set of criteria that look at kind of the beta exposure of the bot. So does it have too many bearish positions? Does it have too many bullish positions? And if it does, it basically self-corrects as it goes. So for example, if the bot exposure is less than 1, and I added some additional notes in here so you can see those, but basically this negative exposure means that the bot's overall positions are hurt by the market rising. So if I've got too much essentially like bullish exposure or bearish exposure in my portfolio and the market rises, then I need to add some bullish exposure, right? And so that's where right now I'm kind of very balanced in my exposure that I'm giving the bot. I'm telling the bot, look, if you go outside of essentially 1% beta exposure on either end, then start to readjust and add more bullish positions to counteract the bearish ones you have, or add more bearish positions to counteract the bullish ones you have. So right now they're pretty even right now. The change that I'm going to be making is I'm going to be making just a very simple change here to this bot. I'm going to do it here with you guys so you can see it. Is I'm going to allow the bot to get a little bit more bearish exposure. So I'll probably take this up to 1.5, see how that works. I might adjust it back or forth, whatever, but I'm giving the bot a little bit more room to get bearish exposure. So it's not until the bot has negative 1.5 bearish exposure that I'm going to force the bot to get into a bullish position. So what this does is it effectively is going to tell the bot, look, you can get, or if you have, or your resulting positions end up having a little bit more bearish exposure, that's okay. And so that's what I mean down here when I wrote in the article that I'm tilting my bot exposure slightly more bearish by adjusting my beta exposure for those positions. Essentially what I'm doing, like I said, is I'm tilting this a little bit more bearish in exposure so that gives my bots room to grab more positions or let positions go if the market starts to become a little bit more bearish and tilt. For me, I want that kind of exposure inside my bots. The other thing you can do is you can also find different trade ideas. I put a link to The way that I use my trade ideas are just one of the filters that I use. Again, you be your own judge. I'm not telling you what to do. You make your own decisions, of course. But the way that I use it with bearish positions here, this link right here on the article goes to the actual pre-filtered setup that I use, which is to find credit spread opportunities in ETFs. They're bearish, 20 to 45 days in this particular example, 100% return on risk and 50% probability of max profit or higher with expected values of more than $5. So if you go here and then you just constantly refresh this chart, this will give you an idea of the different trade ideas that are bearish in exposure, but have what I would consider to be pretty good metrics. So some of the ones that you could potentially start to add if you're looking for some bearish positions and starting to build a portfolio of some bearish positions on a rolling basis, you might want to take a look at some of these moving forward. The other thing you could do is just, of course, continue focusing on any zero DTE trading. I've been doing this. It's my newfound excitement, as I mentioned. I did a workshop on this for some of our Alpha 1 members previously. And what I like to do with my zero DTE trading is basically just use the PEG research that Jack released a couple weeks ago and incorporate that into an actual bot. So for example, I have this, what I call my zero DTE Ninja bot, which has entered a couple positions, been doing okay, about 27 positions in total. And essentially what it does is it goes through a waterfall set of scans at different levels out of the money, different percentages out of the money, looking for favorable risk reward entries. So for example, the first automation that runs is looking at the 0.5% out of the money target. And then at different times during the day, which basically lines up with the PEG research, it's looking for different reward risk levels that it meets. And if it doesn't find any there, then it goes to the next progressive level inside, which is the 0.4% target, and then different levels there. And then it goes through the 0.3, and then it goes through the 0.2, etc. So it's basically just going through this every single day and just starting from the furthest out and then using kind of like a waterfall technique inside of it to see if there's any opportunities available. So if you look here, you can see after approval has been granted for the day, which I run an automation to do that. And then inside of here, I'm asking the bot, are you inside the first scan period? So are you inside that time block? Because that time block, that first scan period of the day, might have different requirements for how much reward risk we would need to make a profitable trade. So once I'm inside there, I check and see if the bot has met that, or any of those positions have met that first requirement for risk reward. If it does, it enters that position, manages the position, etc., lets it go to expiration. And then if it's not inside that first scan period, it checks the second scan period and the third scan period as it goes. So this is where I think about it, because I'm a sucker for a good analogy. I think about the idea of like a waterfall where it's just progressively scanning different time periods and different intervals during the day. So it's a really fun one that you can do. But again, you can find some other trades inside the zero DTE Oracle. So if you just want to focus on zero DTE trades as part of what you're doing, that also works out too. What I like about that and kind of incorporating both into my trading personally is I don't have to commit capital for 45 days for every single trade. So I can now kind of feather in some zero DTE trades. I run that zero DTE Ninja. It runs every day, just looks for a position in a zero DTE trade. Sometimes it gets them, sometimes it doesn't meet the requirements. That's okay. But I don't have to allocate capital for 45 days to wait and see if a trade works out. And what's cool about it to me is that if the markets go really crazy, I can just turn off my zero DTE bot, or I can adjust it to make bearish trades or bullish trades for the day. So I don't have to go into this like darkness of 30 to 45 days for every single one of my trades and hope that it all works out. I can make those longer duration trades in conjunction with my zero DTE trading. And then the final thing that I'll be doing is, again, adding to my VIX hedge. I posted about it inside the community the day the market had a pretty big drop and the VIX kind of went north of 50. It's generally been working out. It's a good one. It's not for everybody, so take a look at it if you're interested. We put some articles on the website on how the VIX hedge generally works, how you can set it up, but just some sort of long volatility exposure in your account. If you're a small account trader, you just need a lot of cash in your account heading into this period so you can kind of weather any volatility that's there and take advantage, more importantly, of different opportunities. So that's really the key thing, is you don't want to be caught flat-footed here. There's a huge opportunity for traders, especially options traders, to really take advantage of probably what is coming down the pipeline, which is a lot of volatility moving forward. So I hope you guys enjoy this research on the Fed rate cuts and what's happened in historical cycles. And I hope you enjoyed just hearing a little bit more about what I'm going to be doing in my portfolio. As always, Make your own decisions. Hope you guys enjoy this research and these tools. And until next time, happy trading.